I'm arguing there's really two types of products, although I'm going to disagree with that argument a little later. There's term and there's perm. I'm going to talk about some of the perm products that really aren't perm products because of a fatal flaw in their design. So how can you tell which one is which? So I put some graphs in here. The reason these graphs, I did them like this, is I want to use real life numbers. So later in the class, we're going to use the mortality table. So I use the actual mortality table that we're going to use to build these charts. So I want to contrast the different types of products. I've got 2 term products here, and I've got 2 perm products here. Annual term and 10-year level term. Ordinary whole life. That word ordinary, all that means is you're going to pay the premium until you die. That's ordinary. Anytime you see ordinary whole life, it's a fix. It's like the most basic life insurance there is. So you buy it. If the premium is $50 a month, you pay $50 a month until you die or you give up on the policy. All right. We're going to find all the other permanent insurance is very, very different than that. And then limit pay whole life, it says you're going to pay the premium until some age, usually to your retirement age. So they say instead of paying $50 a month, you're going to pay $80 a month. But at age 65, you don't have to pay premiums anymore. All right. So this chart's really hard to see because the line's all gapped up. So if we look at it here, the annual renewable term shoots up like that. Why would that happen? Why do the premiums just keep going up and going up and going up? So you got insurance for 1 year, you pay a premium, and in the next year, you're a year older, you pay a premium. Why is the premium going up? Because you're aging. Every year, as you age, you're more likely to die. And so your premium goes up, and it goes up convexly. When you're young, the premium doesn't change all that much. But at some point, I can't remember how much life insurance this was. This maybe $100,000 policy. I can't remember what I did for the policy. And I think this is an annual premium, not a monthly premium. So annual term, you buy it in your 20s. It's really, really cheap. Doesn't change all that much every year. Most annual term is guaranteed renewal. And what guaranteed renewal means is you can buy the next year, no matter how sick you are, you can buy it the next year. The premium's going to go up with the age of everybody in your group. So it goes up with the age of the group and not based on your health. Right? So if you're really, really sick, obviously you're going to renew because you think there's a good chance you're going to need it. You're going to renew. Well, they're going to know that and they're going to put that into pricing, obviously. So that's going to influence the pricing. But annual renewal is just a sharp up premium. Every year it's more expensive based on the life expectancy. Now, I started my mortality table at 25. Do you notice that blue line actually comes down a little bit? This is the male table. So this is for men. You would think as we age, our probability of dying goes up. But for men in their 20s, the probability of dying actually comes down and then goes up. And you want to guess why that's the case? What do men do in their 20s that makes them much more likely to face a death situation? Joe, yeah.
Recreational activities and
War maybe, but recreational, if you include driving a car as recreational, then yeah.
Yeah, like,
It's
hiking or mountain biking.
It's
dangerous activities.
But the main reason is driving. Yeah. But those others probably have some connection with that because you don't see it on the women tables. You only see it on the men table. So men are worse drivers than women. You may not think that, but men are worse drivers than women. So much so that you actually see it in the mortality table. So what happens to you men when you turn 25 to your auto insurance rates? They drop, right? Just suddenly 1 second after your 25th birthday, you become a much better driver. I don't know why, just that second. I've noticed that with my older brother when I was in high school or in middle school. I would walk home. It'd take me an hour to walk home. I'd rather walk home than ride with him. It was so dangerous. And then when he was in his 50s, I rode with him, or actually I drove him from the airport not too long ago. He was like this nervous passenger. Oh, be careful, you're going too fast, stop. And it's like, where you should have ridden with yourself a few years ago. So mortality, we generally think your mortality, your risk of death goes up as you age, but there are some differences. Now, level term, 10-year level term, we'll talk about this, but here's a product where you pay the same premium for 10 years. And then at the end of 10 years, they reprice it. So you notice that level term is going to be more expensive than annual term for some period of time, and then less expensive for some period of time. So level term has this kind of stair step. It also can be guaranteed renewable, which means at the end of 10 years, you can renew. Your premium will go up because of all the group aging, not based on your particular health. But generally, they're going to require a new health examination. Level term is really, really interesting because mortality rates for most Americans, it depends, we have different crises going on, but for general healthy American, mortality rates have been coming down. And level term is a good example of a product that after about 6 or 7 years, you should probably go out and reprice it. You shouldn't wait for the full 10 years because you might actually find at the end of 10 years, this new rate might not be all that much higher. And some people are actually discovering rates came down so much that people in their 30s are discovering that they could buy another 10-year term at the same or lower premium than the existing 10-year term after 7 years. And what would you do after 7 years if you're paying $50 a month and you've done that for 7 years, and after 7 years you could actually go down to $45 a month and get another 10 years? Obviously, you're going to take the lower premium and get the extension in time. So mortality rates for a lot of people have been coming down so much that most people don't actually sit through the entire 10 years. In fact, the only people who wait to the very, very end are the least healthy people. They can't qualify for another 10 years. But you see that stair step, and it continues all the way through the end. And then you do ordinary whole life. Ordinary whole life is fixed premium your entire life. It doesn't change. It's just one premium your whole life. It's going to be much more expensive than term until you hit a certain age. And then, if you're 60 or 70, that's going to be a lot cheaper to have that whole life than to try to go out and buy a 10-year term. Why? Well, because you so overpaid in your younger years that the insurance companies built all that up so that they can use that to help pay for your later years. And then limit pay is obviously going to be higher than ordinary because you're only paying for a shorter period of time. So you pay more, but you say, hey, I'm going to retire at 65. I don't want to be paying insurance premiums at age 65. So I'll just pay the insurance premiums until I retire, and then I'll have free insurance for the rest of my life. Anytime I die, I get the insurance. Now, why didn't I put other products on there? Well, the reason I put other products on there is because they're impossible to put on this chart. And we'll see why. There's too many other factors going on that we don't know what the answer is, so we can't do them. These products we can actually graph with high certainty, but other products we can't. So before we get into different products, the wonderful thing about insurance is its tax treatment. For the most part, most of the time, death benefits are not taxable income. That's pretty cool, right? You pay $100, $300, you pass away, your estate gets $100,000, $200,000 completely tax-free. You can't do that with a lottery, right? You win the lottery, you're going to be paying a whole lot of taxes. So that's a nice benefit. I'm going to check on our Andrew. I'm assuming you're seeing this and you're okay out there. Haven't heard anybody have any problems, so hopefully he's fine. None of you are watching from your desk, are you? So hopefully it's working. All right. So death benefits are not taxable, and the savings element of life insurance is not taxable while it's building up. Now, if you cancel the product and get the savings element out, then you're going to have some taxable issues there. So if you take it as a death benefit, or your state takes it as a death benefit, it's tax-free for the most part. If you build it up as a savings element, and then you say, you know what, I don't want the insurance anymore, I want that savings piece, the cash value, that is taxable. But it was at least deferred until you took it out. So you got that deferral. We'll talk about MEC versus non-MEC here when we get into endowments. Now, Congress, because of that, has discovered there are people doing some wild things with life insurance just to get that tax benefit. And we'll talk about a couple of these products. But one thing is a MEC policy. So essentially what people were doing was throwing a lot of money in the life insurance, and they're essentially doing it so that they either got it as life insurance or they got it as investment. Either way, they're getting this wonderful tax treatment. And while Congress came in and said, if the policy is so obviously a tax avoidance, then they're going to cancel some of that tax benefit. And so that's the MEC. We're going to talk about endowment contracts, which is what the EC stands for, modified endowment contracts. So it's essentially the IRS saying, you're doing something so outrageous that it's obvious the only reason you're buying life insurance is get the insurance, get the tax treatment of the insurance. Now we'll talk about bank-owned life insurance and trust-owned life insurance, BOLI and TOLI, and corporate-owned life insurance. There is insurance that's bought entirely for the tax treatment, and that's when your company buys insurance on your life, and then if you die, they get that tax-free. It's a pretty crazy product. There's still, even with this change in the law, life insurance just have really favorable tax treatment. That's why I argue that if the tax law were to radically change, this industry would shrink pretty dramatically. There's a lot of this industry that only exists because of the US tax code. Without it, it would not exist at all. So probably 70–80% of industry would disappear. All right, let's talk a little bit more about term. So renewable term, as you age, the premium will go up, but you don't have to prove insurability with some of these products. So that's kind of nice. So you know, hey, the premium will go up. I'm going to talk a little bit about that when we get the universal life that has that component to it. But the rate will go up as you age just because of the aging process. Level term, we already talked about that. Convertible term. So when you go work for a company, like when I started my job at UTSA, they just automatically gave me life insurance at one time my salary. And that was a term policy. They renewed it every year. But what they said on that is, hey, if you quit UTSA, we'll give you the right to convert that term into a whole life policy, and you just have to pay the premium. Now, very few people do that because it tends to be really expensive insurance, because generally only unhealthy people do that. And so most people don't even think about it. In fact, the only people who ask about that are people who think they may need it. Most of us like, oh, I don't care. I'm leaving the company. I'm going somewhere else. I'll get term insurance when I go there. So it tends to be really, really high, expensive insurance. But you have this term policy that your employer is providing to you, and you say, hey, you know, I want some insurance. And they say, okay, you can convert it to permanent, but here's your premium. You say, oh, wow, that's a really high premium. So you probably would turn it down unless you're just really unhealthy. Industrial life, I've never worked for a company that sold industrial life. It's essentially funeral insurance. It's a small policy that's just going to make sure your relatives don't dump you in the river somewhere. And so it's just going to pay for the funeral, for the casket. It's inexpensive insurance, but inexpensive in fact, the premiums are low, but the premiums relative to the coverages are actually quite expensive. It's actually pretty expensive insurance. I can't say much more than that because I've never seen this product in practice. It tends to be expensive mainly because of this distribution system. It tends to be a system in poor neighborhoods where people have to go door to door to the process and work through the premiums and set up the policies. I don't know how much the internet has changed this industry, so it'd be interesting to see. But you're usually better off just buying term insurance. You know, it's just the better way to go. It's going to be a lot cheaper relative to the premium you're paying. This next insurance, I don't really care for this insurance, but it's credit life insurance. So you owe money on a car, on a mortgage. And if you die, this insurance pays off that debt. So who's the beneficiary here? Well, it's the bank. This is great for the bank. Why don't I like this? I don't like this insurance, mainly because if you die and you've got a mortgage, let's say you got a mortgage that has a 3% coupon, and you're paying 3% on this mortgage, and you die when mortgage rates are 8%, do you really want to pay off that mortgage? But you rather family keep paying 3% on a mortgage and give them the money and they do something else with it. You know, they could go buy a CD paying 8%, you know, rather than paying off the mortgage. So why tie your hands that you have to pay off this debt with this life insurance? So I'm not a big fan of it. It is a rare insurance where it's actually declining insurance. So as you pay off the debt, the insurance coverage comes down. So it tends to be also pretty expensive insurance as well. I'm sure the bank loves that you have this type of insurance. All right, so we're going to talk mostly about level term. It's the most popular. I'll probably, when we get into pricing, show you some actual numbers. USAA has a calculator on the site that we can compare. We'll do it. I want to do it when we get to the pricing, but we can compare level term versus whole life and just see how much different the premiums are. And you'll definitely see the difference for a 20-year-old versus a 50-year-old. You'll see the big difference in these products. I'm a huge fan of level term insurance. All right, so let's talk whole life insurance. So whole life or permanent is a permanent life insurance. It's very straightforward. You have a set premium, you just pay that premium for life. If you stop paying the premium, you lose the life insurance. If you keep paying the premium, you have coverage. There is a chance where they'll say, hey, if you make it to 100, stop paying the premiums, and they'll just pay it out because they just assume you're going to die at 100. Now, I don't know now with the new mortality tables, they go out to 120 or so. They may not do that anymore. But when the mortality table stopped at 100, if you made it to 100, they just assumed, hey, that's good enough as dying. Here's your money. You made it. We priced it assuming you die at 100, so you made it. We'll give you the money. I like this insurance. It's very straightforward. I'm going to talk about. I actually had experience with my family on this, where they should have bought this insurance. It would have been perfect for them, and instead they bought universal life, and it ended up being almost a disaster for us. You can do limit pay whole life. So if you don't want to pay your entire life. All right, so let's talk universal life. I used to be iffy on universal life. I now strongly dislike it because of my own personal experience with it. So here's the first product this industry introduced because of those high interest rates coming out of the 70s. It didn't fix that. Remember that disintermediation we talked about? People say, wow, interest rates are high. I can borrow money from my whole life at 3%. I can go buy a CD at 15%. Why wouldn't I do that? That's great. So the life insurance industry offered this product. So it didn't fix anything, but what they did is they say, hey, let's have a product so when they cancel their whole life, instead of going to the bank, they'll come to us and buy universal life. So essentially they were disintermediating against themselves. So at least the cash wouldn't leave the insurance company. And so they offered universal life. So a lot of insurance companies offered this, and essentially what they did, it gave them a chance to start over from scratch. So their whole life policies were paying like 3%, 3.5% when interest rates were double digits. So now they offered this new product that's offering these high interest rates. So essentially they have what we call new money rates. So we talked about this disintermediation. You've got a policy with $20,000 cash value. You can borrow 3%, put the money in a bank CD. So now you have a universal life that provides high interest rate. All right, so the huge difference. There's two huge difference between this and whole life. So whole life, you have a fixed premium no matter what. So the insurance company is assuming some investment rate. And they set that at the beginning. They've got to be really conservative on that because they don't know if interest rates are going up or coming down. With universal life, they give you a crediting rate every single month and they can change it every single month. So they don't take that risk. If interest rates fall, they just cut what they pay you. If interest rates rise, they pay you more. So who takes the interest rate risk? Well, they shift that to the policyholder. All right, that's a huge, huge difference. So which would you like better? So here's how they sold this product when it first came out. So in the mid-90s, they say, hey, you know, you got this universal life policy. If you pay this premium for the rest of your life, you'd be covered. But you know what? You're probably going to make more money on the product than that. Because we're assuming, you know, interest rates right up now are 7%, but this product's assuming interest rates are like 6%. So if you make that 7%, guess what? When you turn 65 or 67, you're going to have so much money in the cash value that you can just stop paying premiums. You got insurance for the rest of your life. It's called vanishing premiums. That sounds wonderful, right? You just don't have to pay premiums anymore. And it's so wonderful. What's the big if there? If interest rates do what? Stay the same. What don't they tell you? What if interest rates, what have interest rates been doing? If interest rates fall, then what happens? Well, most people who bought these products assume, well, if interest rates fall and the premium's $350, then I'll just have to keep paying $350. But that's not how it works. Guess what happens if interest rates fall and that $350 is not enough? Could that premium go up? Absolutely. And I discovered that with a policy my mom bought. Now you want to guess how much they went up. So her policy was $250 a month premium. Anyone want to guess how much that premium went up in 1 month? Guesses here? You think it went up to $300? And you take hers for $400? You know it's a high number, so how high do y'all want to go? You think it'd be as high as $500? Are you kidding me? What do you think it is? 450? Anybody want to know the answer? How about $1,562 in 1 month? The premium went from $250 to $1,560. So I took over the policy and started paying the premium. So now we have the issue: do we cancel the policy or do we keep it? The person whose life was insured was in very poor health. So think about what this company has done to us. We have this person that we don't want to die, but we're now paying $1,500 a month on life insurance on their life, and they're in very poor health. Does that sound like something a company should do to a family? Isn't that pretty horrendous? And that's what we had to face. Now, that person did end up passing away, and I did keep paying the premiums. And what I did tell my mom was, I'm going to pay the premiums. If the person doesn't die, then that's just money out of my pocket. If they do die, you're going to have to reimburse me the premiums. So that's the deal I made with her. All right. So she still came out ahead and did all right. So, you know, but now if she had bought the whole life would have been like $270 a month. So you had a choice between $250 a month and $270 a month. But the $250 a month, they were telling her, hey, you know what? Interest rates can be so great. You know, in about 10, 15 years, you won't even have to pay a premium because you're going to make so much. Which do you think she would have been better off for? She would have been much better off paying $270, and I wouldn't have to get involved and all that kind of stuff. I think that's a horrible problem now after going through that. And I was shocked too that it could jump. So, you know, my mom kept telling me, you know, they keep telling me the premium could jump. And I go, well, how much could it jump? What's your cash value? Well, my cash value is like $3,000. Okay. Well, what's the cost of insurance? So you got two things going on here. You have a savings element and you have a cost of insurance. The savings element, the insurance company is paying you an interest rate. The cost of insurance is doing what? What does the cost of insurance look like on this chart? Looks like the blue line, right? Cost of insurance just goes up as the person ages. So what is the insurance company assuming? Well, you're going to pay the savings element, and we're going to pay interest rate, and that savings element is going to grow and grow and grow and grow. And as the cost of insurance comes up, your savings element is going to get so big, it's going to be more than enough to take care of that. But what happened? Well, the savings element wasn't growing nearly as fast as they thought because interest rates were so low. And so they were taking that cost of insurance out of her cash value. And the cash value was just, the cash value was going to keep growing until it got so big it was going to just overwhelm the entire world. Didn't do that. Interest rates kept getting smaller and smaller and smaller. And ultimately, her cash value went to zero. What happened when her cash value went to zero to her premium? Ding, 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 there's her premium. And the person she was insuring was in their 80s. Or you notice what are the premiums in the 80s? You notice what I did on that chart? There are no premiums in the 80s. So you see why the premium shot up from $250 to $1,600 because you went with the cash value supplanting all of that to being no cash value at all. Right. So this gets back to the ethics. What should the lady that sold this to my mom have told my mom when she sold it to her? Should she be able to tell my mom, hey, if interest rates stay high, this premium goes away? Should she have given her another scenario? She maybe has said, interest rates are kind of high. They've been coming down for the last 2 decades. If they do come down, your premium could jump 5-fold in 1 month. What would that do to the sale of universal life policies, do you think? Should you think, this is a good question. I don't know if I had a vote in the class. Should the law require life insurance companies to give that scenario every time they sell universal life? Do you think that should be a legal requirement for them to do that? I kind of in that camp, you should be required to do a positive scenario and a negative scenario. What if they did that with whole life? What would it sound like in whole life? If interest rates go up, your premium is going to be $270. However, if they fall, your premium is going to be what? $270. That's a pretty easy discussion. And guess what policy my mom needed? That's what she needed. All right. She needed a policy where she knew exactly what the premium was forever and ever.
Employees get compensation or commission selling these private insurance.
She got a higher commission selling the universal life than she did selling the whole life. Yeah, no question. I don't know why insurance companies prefer these over whole life. It could be the regulatory issues, the reserving issues. I'm not real sure. They do pay higher commissions on universal life. Yeah. This is the thing I was going to say, because this whole idea of vanishing premiums, this idea that, hey, you buy this universal life, you may not have to pay premiums, and then 10 years later, instead of the premiums vanishing, they're going up 5-fold. This caused massive lawsuits in the insurance industry. And you can even see it. Oh, sorry, Andrea, I'm not even sharing. Yeah. So sorry, Andrea. I guess you can see me from behind, but let me share, since I haven't been sharing. Let me share. So yeah, you can just go into Google or wherever. Where is Google? And you can just do, in fact, if you're buying life insurance, let's say you're buying life insurance from, I don't know, Prudential. Just type in Prudential class action lawsuit with the right spelling. And all kinds of really interesting things come up. They've been sued a bunch, but specifically here, we're talking lawsuits. Yeah, this is specific to vanishing premiums. I forget the lawsuit. It was hundreds of millions of dollars they lost related to these vanishing premiums. This is what happened. So I wanted to do a lawsuit for my mom for this because that's pretty quite clearly what she had. Was vanishing premiums. Unfortunately, she waited 10 years too late to do it, and it was just too late for us to sue. I couldn't find a lawyer that would take it because it's just one person. Vanishing premium litigation, the plaintiff's perspective. So maybe I should go to this guy's website and sue this company. But anyway, it's a huge issue for this industry. Sorry. But I was with you. It's like, wow, her premium could go from 250 to 500. It's like, so I said, Mom, don't worry if that happens. I'll take over the premium. And so I call the company and I go, wait, what did you just say? I should show you what they sent me. I actually asked them to give me several different illustrations. They sent me back this stuff written in the most technical actuarial jargon. It's like, I can't believe you actually sent that to a customer. I mean, no one would know what these terms even mean, except for another life. And a P&C actuary couldn't read this. It was just ridiculous what they sent me. But anyway, so that's universal life. I used to think, well, it's an okay product. But because of that, and there's not a huge difference between universal life premiums and whole life premiums. Whole life's a little bit more expensive, but it's not so much for me that it's worth this risk. Your premiums going up fivefold, that would be pretty shocking. And I think legally companies should have to show that scenario. So that's, you got the crediting, you got the cash value building up, but the cost of insurance is still there. It's still rising. The other thing you have is what we call unbundling. So anytime you see the word universal, you should think unbundled. So this was another unique thing life insurance did, is what they said is, okay, insurance, permanent insurance, you have a savings element and you have the insurance element. And when you pay the premium on whole life, you have no choice. You've got to buy both of those. You have to fund the savings element and you have to pay the cost of insurance. But what we're going to do with the universal life is we're going to have the two premiums. Here's the savings element premium. Here's the cost of insurance premium. If you don't want to pay the savings element, you don't have to, as long as your cash value is big enough to offset the cost of insurance, we're fine. So all you have to pay is the cost of insurance piece of it. You know, if you don't have enough money in your policy, you got to make sure, you know, you'll have to you pay more. But ultimately, all you have to pay is the cost of insurance piece. You don't have to pay the savings element. So it's unbundled. So essentially, you have these two premiums. One you have to pay, one you don't have to pay. And even the cost of insurance, you can pay out of your cash value if you want to. With whole life, you don't have that choice. Whole life, you have to keep paying the premium. If you stop paying the premium, they're going to give you your cash value back, cancel the policy, and you're done. With universal life, though, as long as you got cash value to cover the premium, you're in good stead. One other thing they do with universal life, which I think is quite confusing, is they have two different types of death benefits. One's just a level death benefit. Another one is a level death benefit plus your cash value. So with this particular policy, we just had was a level death benefit. And that's it's pretty important from the policy I had, because I had life insurance, someone who was fairly sick. So I did not want the cash value to grow. And why wouldn't I want the cash value to grow? Pay a bigger premium. I could pay a much bigger premium and build a cash value, but what happens if the person passes away? I don't get any of that cash value back. I just get the life insurance policy. So I was getting that cash value down like the $200, and I was calling the company every month and saying, no, I've got some cash value there, right? Because if my cash value goes to zero, they cancel the policy. It actually went negative, and they give you a grace period. And so I funded it and got it back above the cash value. They kept complaining every time I called in. It says, man, your cash value is getting really low. I was like, yeah, that's what I want. I want to make sure, because I get no benefit from that cash value. Everybody understand that? I get zero benefit from the cash value because I'm only getting the death benefit. If I'd bought Universal Life B, then I wouldn't have been so worried. I would have paid a much bigger premium. And if the person died, I would get the life insurance and I'd get the cash value back. So paying that extra premium wouldn't have hurt me. So y'all can see with Universal Life A, when the person's really sick, you almost want to let that cash value get down close to zero, because you're not getting any of that benefit. All right, everybody understand? I can't tell if y'all not making sense. All right, so that's something to think about. With whole life, you don't think about that at all. So it's a very different type of policy. You remember with the whole life, people were borrowing from their whole life like at 3% and investing in bank CDs. Well, Universal Life has much more market rates on the borrow and the cash value, and they usually penalize you for borrowing. So it's not as lucrative to borrow against your policy. We'll talk about it a little bit later about borrowing from life insurance. But I actually think this is the single biggest change, and that is Universal Life is sold not as life insurance anymore. It's now sold as an investment. And that's why, and I remember seeing I think I talked about this on one of the Zooms, the advertisements, these trifles they would send out for Universal Life. There was one massive number on the front, and that was the interest rate they recently paid. I say 6%, 5%, 4%. You didn't see that with life insurance before. When you saw whole life, you know, the brochure was pretty boring. You want $500,000 in insurance? Well, then pay us $300 a month and you have it. There was no interest rate. There was nothing. They just, you know, it's $300. You go to the competitors. Theirs is $270. Buy from the competitor. Very simple. Now with Universal Life, maybe your premium's $300, but that's based on the assumption they're going to pay you 6%. But next month they can pay you 4% if they want. So your cash value won't be as large as you thought. So your premium might go up. So now you can't compare product A to product B between two different companies because you don't know what they're going to be paying you on the interest rates. So you can see how the complexity of this is starting off. Could a company push Universal Life in August and have a really high crediting rate and sell a bunch of Universal Life and in the next month cut their rate? Could that happen? Absolutely. That's perfectly legal. Anybody know what that's called? There's a term in that. Where's our life insurance salesman? Is he not here? So it's called bait and switch. You ever heard that before? Bait and switch. You reel them in with a high rate. You advertise it. You have this one time of year, you really advertise it. And then once you get them all in, you cut their rates really fast the next month. How would you know if a company does that? Well, you can look historically. There's one product they sell in life insurance. They mainly sell it to teachers. Guess when they have the highest rate all year long with that product? What month of the year do you think? Well, in August. Why in August? When teachers come back on campus, they got to make decisions. They pick, they look for which one they want. You'll see it. Highest rate in August, and then they cut the rate the next month. So it's kind of caused bad behavior because companies they're pushing the rate, and when people are saying, well, this company pays 7, this one only pays 6, so I'm going to go with the 7%. Well, they're paying 7% this month. Well, what are they going to pay next month? And what have they done historically? And it makes it, I think, practically impossible to compare two products. So we're getting to complexity. So you have an ordinary life, whole life, you charge $50 a month. Whole life, very, very simple. Just pick the product that's the cheapest. It really is pretty simple. As long as the two companies are not going to go insolvent, go out of business. Yeah, just pick the one with the cheapest premium. It really is that simple. But Universal Life, they're going to advertise on the rate. They're not even going to mention the cost of insurance. Two insurance companies have radically different costs of insurance. So you might want to know that. That's what I was asking on the policy I had is that what is the cost of insurance at age 87, 88, 89, 90, 91? How much does it jump up? Because if my cash value is practically zero, my premiums are going to go up. Now, the nice thing about this policy is that the premium was guaranteed for a year. All right. So then I get real nervous every December. So, okay, December, how much is it going to go up? And so they actually sent me a schedule where I could see, okay, it goes from 1560 to 16 something to 1700. And it's going to be pretty steep as they get into their 90s. It's going to get pretty steep. But at least I know for 12 months, it's not going to change. And then it's going to jump, and then I have that period of time again. But one company's cost of insurance can be radically different than another. The credit rates can change, which means the cash value is going to grow at different rates. Yeah, there's almost no way to compare. And this gets back to my argument. If it's impossible to know if company A's product is better than company B, I would suggest you don't buy that insurance. I think that's just insurance. It just doesn't make any sense to me. Anytime you can't comparison shop. But then the other thing we got to realize is that universal life is the first of these type of products, and it's the least complicated. So this is the least complicated. We got the crediting rate, the cost of insurance, we got the borrowing rate. You know, you've got three things that just by themselves make this almost impossible to compare. So what do you pick between A and B? Company A, their cost of insurance is $50 a month. Company B, their cost of insurance is $75 a month. Which company do you pick? Well, based on cost of insurance, go with company A. Company A pays a rate of 4.2%. Company B is paying 7.3%. Now, which company do you pick? Would you rather pay $75 in cost of insurance, get 7.3%, or pay $50 in cost of insurance, but get 4.2%? Can you do that math off the top of your head? My guess is probably not, right? It's probably pretty tough to do. That 7.3 is not very valuable to you for the first 3 months because you don't have much cash value, right? The 7.3 is against your cash value. Your cash value starts at 0. What else might you ask about company B? How stable is that rate? Does it stay, you know? You could look the last 10 years and see how competitive they were versus company A, right? If their rate was 7.3 and then dropped to 3% the next month, you know, historically, you might say, wow, this is a bait and switch. That's kind of tough. They also have a loan interest rate. Company A charges 4.8%, but company B charges 8.9%. You know, it's very, very difficult. The other thing I don't have here is the cost of insurance. This is the cost of insurance the year you buy it. What's going to happen? The cost of insurance is going to rise, but they may not rise at the same rate between the two companies. So that's the other thing you have to consider. Now, you actuaries in the room, what all would you need to give you great confidence whether to pick A or B? You probably have to set up what, a few thousand scenarios? And even then you're not sure because you don't know what they're going to do on their crediting rates going forward. You can look at what they've done in the past, but that's not going to tell you what they're going to do in the future, right? So I don't like this product at all. Now, I used to be blasé on it. Now I really dislike it. So now I'm going to ask the question, is this even permanent insurance? If your premium can go from $250 to $1,600, what have you just done? If all I'm paying is the cost of insurance because I have no cash value, don't I have a annual term policy now? I just converted from a permanent to an annual term, and that's essentially what happened to me. I went from a permanent policy to an annual term policy. So I don't even think you can call this permanent insurance anymore. Anybody want to argue for variable life? So yeah, I don't know what happened to Cameron. Where is Cameron? The other Cameron. Are you this life insurer?
Yeah.
Oh, you are. I didn't recognize you with your glasses and your hat on. All right. You want to argue for universal life?
I really want to do it universal life.
Yeah, it's a terrible time to buy anything. Well, State Farm is a really good term writer and probably has really good whole life, and it's a trusted company. Yeah, I mean, it's easier for you to sell term and whole life, isn't it? You don't have to explain it so much. Universal life, well, you have an incentive if your commission's much higher, but you know, other than that, yeah, why would you go to that trouble? So this is the product when my mom bought it. She thought she was buying an annuity, so she was really confused on it. But it's interesting, Cameron, that her salesperson left stuff with my mom that she wasn't supposed to leave with my mom, and I have all that stuff. So that's why I think a lawsuit, I could probably make a pretty good case that my mom was a little bit oversold. So anyway, just be aware. So this Thanksgiving, you can go see if any of your relatives have universal life, and then you can make them really upset. So it's like, wow, I can't believe you bought that policy. All right, let's add another word. Variable. Variable life. So we got universal, now we're adding variable. What is variable? Well, remember that second disintermediation for the stock market? So the life insurance industry said, wow, all this money is going to the stock market. We should be able to do some of that. Well, that's kind of tough. How do you do that? Well, instead of having universal life where we pay 7% or 6% or 5%, why don't we instead we credit their policy with whatever the stock market does? Wouldn't that be great? So now their cash value grows with the stock market, looks just like universal life, except for their cash value is going to grow with the stock market. Stock market's up 10%. Wow, their cash value is going to grow 10%. That sounds pretty cool, doesn't it? Well, except for what? The SEC regulates investments. And what is this starting to sound a whole lot like? This is starting to sound like a mutual fund investment. And so guess what the SEC did? They sued a company called Variable Universal Life Insurance Company, VALIC. I think they're still in business. I should look them up. Variable Annuity Life Insurance Company, so VALIC. They sued them and they said, we're going to regulate them. We're going to talk later in the class. Now, the laws right now, insurance companies are regulated by the states, not by the federal government. And that was actually in law. And so when the SEC says we're going to regulate this product, VALIC said, no, you're not. We're regulated by the states, and the law says that. The SEC says, well, SEC said, well, that was when you were doing life insurance, but now you're doing investing. That's our stuff. And so they got sued, and VALIC lost the lawsuit, and the SEC regulates these products, as does the state. So if you sell this product, you have to have licenses both from the state and from the federal government to be able to sell these. So you have dual regulations. And the SEC said, hey, you know, this is pretty risky stuff. The policyholder is going to see their cash value going all over the place from an industry that in the past has had these very predictable products. The premium is fixed, so you have to pay the premium. This isn't like universal life. So you got to pay this premium, but your cash value can move all over the place. And you're adding another layer of fees. Because what these products do is they're essentially sticking you in mutual funds as the cash value, and then they've got to pay the fees. So you got another layer of fees on there. Now, I called a company. I had this one lady I was helping, and she had a product like this. And I was just curious, what mutual funds are you in and what fees are they? So I called their insurance company. I says, I just want to know what the mutual fund fees are. What are their management fees? And the lady on the phone says, oh, there are no management fees. I said, well, no, for the underlying mutual funds. She said, no, there are no management fees. She's not understanding my question. I didn't know how to ask it. And I've learned, you know, if you don't get someone like Cameron who knows what they're talking about, then you do this, you know, the line, got a bad line, you say, let me call back, and you get another salesperson. Right? Cameron probably will that. If you don't get the good person, you call back and you get the good person. So I called back, and that person gave me all the fees. But I was like, last person I was talking to, she was telling me there was no fees for this product. And I'm just like, no, that's not true. So there's that extra layer of fees, and you don't know what those fees are unless you know what those funds are. So it could be Vanguard, it could be Fidelity, whoever. When USAA did this, we did it with Vanguard. But you have those underlying fees that you're paying in addition to all the other fees that the insurance company is going to charge. So if you go out to Susie Orman, y'all heard of Susie Orman? No? She's probably not so famous anymore, is she? I know her better from Saturday Night Live because they do a parody of her. I don't know how to spell Susie Orman. But I won't do variable life. Well, let me do variable life. What do you think Susie Orman thinks of variable life? Can y'all see? I wish computers would work here. You see any words there that kind of stick out at you? They are bad investments. She hates them. I strongly dislike Susie Orman on most things, but I agree with her here. Have y'all seen her parody on Saturday Night Live? It's Kristen Wiig. She does Susie Orman better than Susie Orman. It's really hilarious. But she hates these products partly because of the multiple levels of fees. Remember we said earlier, the life insurance industry has more expenses than most companies. So their products, they have to charge more because they got to cover more fees, but they offset of that is they have these tax advantages. But now we got a product where we have all the fees the insurance companies charging. Now they're laying on another level of fees of the mutual funds. So it's just fee after fee after fee. So it's just getting really expensive to buy this product. But yeah. Now she doesn't even like whole life. So, but index universal life, bad investments. But she really, here she is talking to me. Well, I should play that video. I'm sure she doesn't like it. Do y'all recognize her? I'm surprised she's fallen that much out of favor. How many of y'all have never heard of Susie Orman? My word, boy, what's happened to this poor lady? So,
Maybe it's a good thing for her sake. So maybe it's a good thing for her sake.
yeah, she's a little strange, and that's why Kristen Wiig, when she does on Saturday Night Live, she does it so well. It's pretty hilarious. Anyway, I shouldn't make fun of Susie Orman, but well, I shouldn't talk about him either. I disagree with his put money in envelopes. I'm convinced there's people going to churches after Dave Ramsey and following them home so they could rob them a few days later. I don't know why he says you shouldn't use credit cards. I don't understand why he says you should pay off your smallest credit card first and not your highest rate. That makes no sense to me. My biggest concern though is his kickbacks on the mutual funds he recommends. I don't trust that. I do think he's getting kickbacks from the industry. I read a book. I can't remember the name of the book. I could find it where they talk about him and the deals he has. It gets back to the commissions. I don't think if someone's selling you something and they're getting a kickback, I don't think they're going to give you good advice. I plus don't think he has any training whatsoever in investing. So I don't think he's actually qualified to recommend mutual funds. And how do these people recommend mutual funds? Well, they go out and find 4- and 5-star Morningstar funds that pay them good fees. But there's 4-star funds do no better than 2-star funds going forward. They're all the same. So yeah, so I'm not a big fan of that. I think he's great on budgeting. You shouldn't live above your means. You shouldn't borrow money if you don't have to, those kind of things. I agree with that. I don't like putting hundreds of dollars in envelopes so that someone can come rob you. But all right, so we're getting more and more complex, and we're getting further away from insurance and getting much more like investments. So these products are just getting almost incomprehensible. Well, then what do they do? Let's say, hey, you know what? We got this complexity. We got this complexity. What if we combine those two complexities? Complexity squared. And so they came up with variable universal life insurance. It's the variable product, so it's tied to the stock market or the bond market, any mutual fund you can go into. And in universal life, where you have the two premiums, savings part and the cost of insurance part, and you have that choice. So variable universal life became the main product there in the 80s and 90s when the stock market was doing so well. Extremely expensive product. We'll talk about variable annuities a little bit later. These type of products, if you run like stochastic models, you run a lot of models. The only way you can get these type of products to work with all the fees is you got to hold them for 25 years, such that the tax benefit catches up with all the fees. That's about the only way that you can get these things to work. I'm not saying they're always bad. They can be good if you're really going to hold them a really long time and you get a good stock market. That huge tax advantage really does pay off in the long term, and it's, you're getting that tax deferral for all those years. It really can benefit you. But if you're going to hold it, if you change your mind 5 years later on a product like this, one exception, I probably shouldn't do this on tape. One exception, if USAA ever sells this product, you should probably buy it, because USAA sold these products, and you cannot sell these products through a direct marketing like USAA. So USA does products like this, discovered they can't compete. They want to shut the product down. The only way they can shut the product down is by really sweetening the pot to their policyholders. So if you'd had this product at USA, you would have been really happy because they essentially had to buy you off to shut the product down. So if USA does it, you might do it just because they're probably going to have to shut it down. It's a hard product to sell if it's over the phone. You just can't do it. It's just too complicated of a product to do. They wanted to sell it mainly because it was the hottest product going. Everybody was buying it. They had success with Universal Life, but you can see even Universal Life is pretty complex, but these products are just really, really hard. Now, this is not the most complicated. So when we get the index products, that's when it's getting really, really complicated. And Cameron, I don't know if you do index products, so I'm really step on your toes if you do those. All right. Y'all get y'all get the understanding of my complexity argument earlier. These products are big. How in the world would you compare this product with any other product? I don't think Albert Einstein can figure out who has the best product here. So now Thanksgiving, you're asking questions from your relatives if they have any of these products. And the uncle that really irritates you, this is your chance to show. It's like, yeah, I don't think you should have bought that product, Uncle Ted. That was a really bad decision. This is your chance. All right, endowment life. So endowment life is a policy the tax law changed and made this product not so tax favorable. However, I still think it's a great product. I think it's probably undersold. So endowment life, the way it works is you pay a premium. If you die, you get the face of the policy. So let's say it's a $200,000 policy. You pay the premium. If you die, you get $200,000. If it's a 10-year policy, at the end of 10 years, if you die, you get the $200,000. And if you don't die at the end of 10 years, you also get the $200,000. So for the first 10 years, if you die, you get $200,000, and at the end of 10 years, you get the $200,000. You can see how, from a tax standpoint, that would be incredible, right? You're investing your money; it's all tax deferred. If you die, you get it tax free. If you live, you get it tax free. It's like a tax-free vehicle where you can just convert something taxable, and that's where the IRS said no. If you die, it is tax free because it's life insurance, but if you live, that's going to be taxable. But the reason I think it's still a good product is you're still getting that 10 years of deferred without any taxes. So if you live, you get the 200,000, but you have to pay tax on the gain. It's still 10 years of deferral. A bank and an investment firm can't do that. You know, you can buy a traditional IRA and then you get the deferral, but only up to the tax code, right? Whatever tax code allows you to do, the 5,000 or whatever you can do. So it's still a good product because you get that tax deferral. I'm also going to show you this product has what we call a pure endowment policy, which I really love, which is if you die, see, how do we have it? If you die, you get nothing, but if you live, you get the 200,000. That's a pure endowment. So you only get the money if you live. All right, so I'm going to talk about this benefit. So this is the product I'm going to show you that like at 25, you can pay like $3,000. And if you make it to 90, the insurance company pays you like $3 million. All right, sounds pretty cool, right? So you pay $3,000 a day. If you die, you lose 100% of the 3,000, but if you make it to 90, you get $3 million. Pretty interesting product. So I'm going to talk about that as a salvation for people who did not save for retirement, because with a little bit of money, you can get a huge payout. But you got to lose all of it if you die too early. All right. So that's a pure endowment. Pure endowments are not that popular. They're not really sold by the industry, but I'm going to show you a product that I think makes it work very, very well. All right. So that's endowment life. This is the one on the exam 2, not exam 1, on exam 2. You're going to have a massive problem with this, where you're going to price it, give me the price for it, and you're just going to walk it through each year. The person lives, they get paid. If they die, they get paid. I mean, if they die, they get paid, and at the very end, they're still alive, they get paid. You're going to walk it through and show that the math works. So you'll definitely see this endowment life on the second exam. All right. All right, I'm going to start here next class because I don't want to start joint life yet. There is something I do want to talk about in this class. I'm going to have to work at the math for the second part of the class, but this is an issue you all need to be aware of because your parents are about to go through this. So your mom or dad has some military retirement, some pension or something, and they have a choice between joint life or single life. All right? If they do single life, maybe they're going to get paid $800 a month or $1,000 a month. But they do dual life, maybe they only get $800 because it's going to keep paying until the second dies. So we're going to talk through that. Which of those do they choose, or maybe they choose one and use life insurance to make up for the other. So we'll talk through that. This product's going to set up that equation. And there's a lot of people make a really bad decision on that because they don't really think through it enough. All right, that's it for the night. Andrew, I hope you got all of that. Sorry I didn't share my screen very well. I wanted to show you something from what I did something today to give you a little bit of a sense of universal life versus whole life. So I did a universal life product for $150,000, and I did a whole life policy for $150,000. So $150,000. There's the monthly premiums. They're really, really high. The reason they're high is because interest rates are so low right now. So they're pretty expensive. But the difference was larger than the last time I did this. That probably has to do with interest rates being pretty low. But how much do y'all remember? Can anyone explain the difference in these two? Why wouldn't you just buy the 285? Why isn't that the obvious solution? Two insurance products, they're both 150,000 bucks. Anybody remember it, Cameron? I'm sorry? Yeah, payments can change in universal. How much can they change? A bunch, right? So they can go up fivefold in 1 month. So is that something you should be worried about? Yeah. Given what my mom was buying this product for, she should have gone with the whole life. They would have never noticed the difference. An extra 50 bucks a month was not that big of a deal to them. I mean, just think in 1 month, they had, you know, what, like almost 2 years they would have wiped out of the savings there. So these are real life numbers. The bigger the product gets, obviously the bigger the difference is. So it gets a little tempting if you're going to buy $500,000 of insurance. Right now, you might say, well, buy the universal life because interest rates are so low. How much lower can they go? So you don't have that much on the downside risk. And if they go up, you can get more out of the universal life. So maybe right now, you're a little more tempted, right, to buy the universal life. But there's still that risk. Interest rates stay low. You know, you look at Japan. Their interest rates fell and they stayed low for what, about 30 years? And they're still really low. So rates can go low and stay low for quite a long time. I didn't buy the product because I don't need life insurance, but just to show you the difference. So you can actually price these online, but now you can help someone out, you know, give them a pretty good insight of what could really happen in the future. All right. Now we'll see if that trick works. If I bring in the class notes. Is anyone in the room on Zoom? I don't think so. All right, can y'all see the word, those that are on Zoom?
Yeah, we can.
So it worked? Wow. See, I can learn. I'm not that old of a dog. All right, so we're going to talk joint and survivor life insurance. We'll get a little bit more into it later in the class, but joint survivor life insurance, it can either be the first to die or the second to die. So essentially what the insurance says, the insurance is on two people's lives. If it's first to die, then the life insurance pays as soon as the first of those two dies. This is probably when you have one person that's the main, you know, has the main income, maybe they have a pension, or maybe they both have a pension and you need both pensions. So if one person dies, the other person is going to really be destitute. So once the first person dies, it pays the insurance, they can then make up for that lost pension. That's probably the most common die, because that would make the most sense. So the first to die, you have two people, husband and wife. The wife dies, the husband gets the life insurance. If the husband dies, the wife gets the life insurance. The second to die policy is probably if you're worried about estate taxes of some kind. And you want to make sure, the first dies, we're okay because we got this great pension. Either one can survive without the other. But once the second one dies, we got this massive estate, and we want to pay the estate taxes. If you set it up correctly, the life insurance can be a really good tax efficient way to do that. You just got to be real careful. The IRS doesn't like you paying estate taxes with life insurance if you don't set it up in the right way. So I forget what the tax rules are because I haven't looked at them in a while. But if you're going to use life insurance for estate tax planning, talk to your advisor very carefully to make sure you do it in a way so that it actually is tax-free. So the question I have to develop a problem. I'm going to have to develop one for the exam, because I've seen it with my own family. It's really, really critical. So let's say let's say the wife has a pension. She has a choice. She can do it only on her life. And that's going to pay her, say, $4,500 a month. Or it could be a joint life. That's going to pay, say, $4,000. All right. So she gets $4,500 a month. If she dies, it disappears. They lose the pension. Or she can do a joint life. So let's say her husband doesn't have a pension. So they're both living off of a pension. And then she dies. Well, if she got the pension with the joint life, then the $4,000 continues even after she dies. All right, so that's the choice she has. But what's the other choice that she could do? She could do only on her life, and then do what? Buy life insurance. Where does she get the money to buy the life insurance? Well, she's got an extra $500. How much is the extra life insurance? Maybe it's $200. So she gets the pension just on her life. So she gets the $4,500. She takes $200 of that, buys life insurance. She's $300 better off. How much life insurance does she need? Does she need enough to create the entire $4,500? Maybe not. Right? Maybe the husband could live off of $3,000 a month. So what she needs to do is figure out how much life insurance do I need so that if I die, I get enough life insurance so I can get my husband $3,000 a month for us of his, that can produce that income. I'll see how that works. The math isn't all that complicated. It's a present value kind of math. But that's what you could do. What if the life insurance is going to cost her $800 a month? Well, then she should just get the joint product. That would make a lot more sense. Now, most people who make these decisions don't sit down and do that math. I don't know, Cameron, have you ever done this analysis for someone? Well, no, they've got a pension and they're trying to decide whether to do the joint pension or do single life and make up the difference with life insurance. Have you ever had that question come to you?
Not directly, but with the next or the difference. But I did
I mean, it's a big question, right? Because how many chances do you get to change your mind on this? Zero. This is a permanent decision forever. Once you make the decision, you get that first $4,500 check, you're set for life. It's a really, really important decision that people spend very little time making. My parents made the decision with very little thought. Now, they did exactly this. They did it on one life, and they bought life insurance, but they didn't buy enough life insurance. So that was part of the problem. They bought life insurance, but not nearly enough. They should have sat down and done a lot more analysis. Now they have a son who's a life insurance actuary. You would have think they would have talked talked to him, but they didn't talk to him at all. So they had some pretty good resources. I was their other son. They could have talked to me as well. So your parents are probably quite a ways away from making this decision. Although I had a student in my earlier class, he's your age and his dad is 71 years old. And I was like, how is your dad 71 years old? You're only 20 years old. So most of your parents are not 71 years old, I'm going to guess. They're probably what, 40, 45. So they're still quite a ways from this decision. Now, military has this decision, don't they? I had a friend of mine in the military, he had this decision on what does he do with his military retirement. Have you ever looked at the difference and see how much it is? And how much life insurance you get paid with the difference? That's the kind of analysis you need to do. All right, so we'll get into that a little bit more. I'll try to come up with an actual number crunching with real life numbers so you can see the difference. So what can you create? Well, a life insurance company can create any product you can dream of. What an actuary needs is they got to know what happens when you die, what happens if you're alive, what interest rate can we make on the money. So you're going to see on the second exam, I have this ridiculously crazy product, and we're going to work a few examples in here. You don't have to worry about it until after the first exam. Just crazy, crazy examples. And I'll show you how to work through it. The first time I did that problem on an exam, only one student got it right. And she wasn't an actuary, she was a finance major, but only one student got it right. She got it to the penny, which was pretty impressive. Since then, most of the actuaries have started getting it right because I've started showing more problems in class. And so there's more and more people get it right. There's at least 25% of the class that hands in a blank piece of paper on that question. That frustrates me that they don't even put anything down. You should be able to put at least some basic things down. But I'll show you some of those problems, but there's almost no limit to what an actuary can do if it depends, if the payment depends on whether you're alive or dead, and they know the timing, they can create any product. The question is there a market there? So actuaries can handle quite complex calculations. So we'll get into it. You'll see some of these. Actually, some of the crazy products I created, once you look at them, they look kind of interesting to me. I see someone and you say, wow, that I don't know if I wouldn't buy that product. That sounds pretty interesting. So, all right. Participating policies. I used to think these only apply to permanent policies, but State Farm had one for a term policy, so they can apply to perm and term both. But life insurance is really, really risky, especially permanent insurance. If you sell a whole life policy to like a 25-year-old, you're essentially telling this person, you pay this premium for the next 5, 10, 15, 20, 50 years, however long you live, we're going to pay you all this money. Well, if they made a mistake in their mortality tables or in their interest rate assumption, they're stuck with that until this person dies. And so what participating policies say is, okay, we're going to charge you more than we should charge you. So maybe your premium should be $250. We're going to charge you $275. We're going to take that extra $25. We're going to put it to the side. And 5 years from now, 10 years from now, if things work out the way we thought, we're going to give you some of that money back. You're going to participate. So we're actually going to overcharge you. And then once we see how things work out, we'll give some of your own money back to you. And the nice thing about that is it comes back to you tax-free. So you don't have to pay tax. It's a return of premium. So some of that return as a dividend really is earnings because the company had it, they invested it, made interest on it. Now they see they got more than they need and they can give that back to you. And so it's essentially a way to make some tax-free income. So they actually pay you a dividend. This dividend we'll see later. You remember in your accounting statements, dividends to stockholders don't come out of net income. They come out of stockholders' equity. But this dividend actually comes out of net income. It's a dividend to the policyholders, not to the stockholders. So it's an expense. And this is what I was talking about. Some people preach participating policies are bad because they're overcharging you, but there's nothing that requires them to give you money back other than the competitive forces. So if they don't have to pay you back, then why wouldn't they just keep your money? Well, because they want to be competitive, right? They want to have a good product and compete. What I don't like about participating policies is just one more level of complexity that's being thrown on top of what's already pretty complex. So what can you do with all of this stuff? So if you need to compare two policies, and I would put in your notes that this is really, you're trying to compare two whole life policies. This doesn't really work for universal life or the other complicated products, but for two whole life policies, you're trying to pick between them, and they're both participating. So you're going to know what's the best deal. And there's two approaches historically. There's a traditional approach, which I don't use anymore. I don't think makes much sense, and the interest adjusted. But the traditional approach is a good way to start because it's simpler. So it gives you a sense of how this works. So what the traditional approach does is they look at the policy maybe after 3 years or maybe after 20 years, and they want to see how much does this policy cost you after you put everything into place. So they say after 3 years, this policy paid you $196 in dividends. So that's money coming back to you. It's got a cash value at the end of 3 years, $29.63. So if you cancel the policy, you would get $29.63, plus you got $196 of your money back. So the company, if you cancel the policy at the end of year 3, you would have gotten $3,159. 196 dividends paid to you, and you get your cash value. Your premiums were $65.61, so your net cost was $3,402. That's what it's called, the traditional net cost approach. How do we know it's a participating policy? Because it's paying a dividend. If it's not participating, you don't get a dividend. They just keep all the money no matter how well they do. Although I don't know if that's, legally. I mean, I have my auto insurance from UTSA, and they paid me a really nice dividend last year because no one was driving, and that's not a participating policy. So I guess if a company decides to pay your money back, they can do it. But a participating policy is actually built in the policy that's somewhat expected. So we like to price life insurance on a $1,000 basis so that you can compare a $500,000 policy to a $200,000 policy. So this is a $100,000 policy. How many thousands are there in 100,000? 100, right? So you take $100,000 divided by $1,000, there's 100. So 3,400 divided by 100 means that this policy costs you $34 on a net basis, $34.02 per 1,000. However, it's been 3 years. So we want to then divide it by 3 because it's been 3 years. So we can say this policy costs you on average each year $11.34 for every $1,000 that you purchased. All right, so then you can compare that same number to a $200,000 policy or a $500,000 policy. It costs you $11.34. Right, so the dividends plus the cash value is how much you get. Premiums is how much you pay. There's the net divided by how, the face of the value divided by 1,000, divided by that number, divided by 100, and then divided by the number of years, and you got it. What's the one thing we didn't adjust for here? That's really important in finance. Time value money. We ignore time value money, so we'll make that adjustment next. But let's look after 20 years. 20 years looks too good to be true. You got $10,000 in dividends. Your cash value at the end of 20 years is $35,900. So the company's giving you $46,000, but you only paid $43,740 in premiums. You actually got more money back than you paid in, and that's absolutely true. But what's missing from that analysis? Time value money. All right. But it looks like you got free life insurance. If interest rates were 0%, that would be true. If there was no time value money, you got more back than you paid the company. You divide that by 100, divide it by 20, and this policy actually paid you $1.32 for every $1,000 of insurance you purchase. But if that's the case, then go out and buy $1 trillion of insurance, right? That'd be great. Come out way ahead. You'd be way out of pocket the first few years, but by the end, you would have a net benefit. It probably wouldn't work very well. Why not? Well, because we need to do the interest adjusted. So there's a great magazine called AM Best Review or Best Review. They publish one for the life insurance side, and they publish these indexes all the time. And I think it's one of the most powerful things that they do. If I were buying a participating whole life policy, I'd really want to see one of those studies that they do, but I would want to see the interest adjusted one. That would be more interesting to me. So how much of a difference does it make? Well, what we do is we take everything to the future value, all right? So the dividends at the end of 3 years, the dividends in future value terms. So essentially what we're saying, and I think I'm using a 5%. Yeah, we're using a 5%, which is a really high rate. If we're taking these dividends and we had invested in it at 5%, at the end of 3 years, they would have been worth $200. All right, everybody see that? We got these dividends. What does that tell us? Those dividends must have been kind of backloaded because we only got $4 in interest. So most of those dividends happen in year 2 and 3. So if we had taken the dividends and invested at 5%, the cash value is the same. Why is the cash value the same? Because that is the future value at the end of year 3. That's what you would get in year 3. So it's already a future value number. We do the same thing with the premiums. What would be the future value of the premiums if we had used 5%? So that would have been, instead of 3402, I'm sorry, 6561, that would have been 7239. So now my net cost is much higher. And why is that? Because we pay the premiums up front and we get the dividends delayed and the cash value is already future value. So the premiums have the biggest impact because we're paying them up front. Everybody good on that? I know it's 9:30, but your mind's kind of remember all your present value and future value numbers. All right. On a per 1,000 basis, that's $40.76. Now we want to bring it to the present value, but we can't just divide by 3, can we? So now we divide it by the future value interest factor annuity for 5 years. So we want to divide that 40.76 by that future value factor so that we can get it on essentially an annual basis adjusted for our interest rates. And that's $12.31. And I actually think that's a really good number for comparing policies. Same thing on the 20-year, the dividends get massive. Instead of 10,000, they grow up to 14,000. What about the cash value? Exactly the same, right? Because that is the cash value in 20 years. And that's really what hurts you the most. That's already in the future value terms. So you're getting 50,000 back, but the premiums, boy, they're much, much higher. They almost doubled, right? Or not quite, 43,000 up to 75,000. So that future value of the premiums is massive. So your net cost is no longer negative. Your net cost is still positive. You convert that. So this insurance is costing you $7.46 per 1,000 insurance. You now have a number that you can compare to another policy of another company. And you've adjusted for what? The cash value, the dividends. You've got a pretty good idea of which company's got the better product. So if another company has a interest adjusted net cost of $8.17, this is the better product. It only costs you $7.46. All right, that sounds really good, but there's one serious problem here. These are actual numbers. So this is how the company did the last 20 years. You're going to have a tough time buying insurance 20 years ago. So you can't buy this product. It doesn't exist anymore. So how do you use this? The way I use this is I want to look for companies that have historically done well here and assume they'll continue to do well in the future. So you're essentially just saying, do they have a good track record? Now, it used to be much cooler in the past, but I think the regulations have changed. This doesn't work. I wish they still did this. But companies used to report an illustration of the product where they give you these numbers, but what they think is going to happen in the next 20 years. And what I love to do with AM Best, but I don't think you can do it anymore. I wish I could show you some of these pages. It was really quite comical. You could take, 50, 100 companies, you could take the historical 20-year index, and you could take their illustrations. And what you discover is the companies that ranked really high on the illustrations ranked really low on their historical numbers. And what does that tell you about the illustrations? It's pie in the sky. They were exaggerating numbers. And so what I was looking for are the companies who scored really well historically, but didn't look all that great on the illustrations, because what does that tell me? The illustrations were honest and accurate, but when you really came down to it, they gave you a good deal. And that's how I was looking for companies. So a company that ranked 27th on the illustration and number 3 on the historical, I'm saying that's probably the company I want to do business with. What's happened though is the regulators have really clamped down on illustrations. And so firms don't like providing those anymore because you have to be much more honest. So you can't do that, but you can still look at the historical numbers. Most companies are fairly consistent over time. Most companies that are very competitive historically are probably going to continue to be competitive going forward. So you could use that. The last time I checked, the UTSA library did have best reviews, but I haven't checked in a long time, so I don't know what they have. But that's a great resource to have. But why wouldn't this work for Universal Life? Why can't I get an interest adjusted net surrender cost index for Universal Life? Well, because their cash value is going to be all over the place depending on one product versus another, right? Because that all depends. Remember, with whole life, you have the interest rate, it's set forever. It doesn't change. You know exactly what those cash values are going to be. Universal Life depends on what the company pays you. So they're going to fluctuate constantly. So especially on the illustration is, their guess on what interest rates are going to be in the future. And if one company is conservative, they think interest rates are going to be 4%. Another company is aggressive, I think rates are going to be 6%. The one that says the 6%, their product's going to look wonderful. So yeah, it's with whole life, you can't do that. You can play around with the dividends, but you can't play around with the cash value. And so if your illustrations are up, you can see how they could really lie on a Universal Life policy. All right. So those are 2 approaches. The interest adjusted approach has some power to it if you're looking at whole life. Other products, I don't think it's all that valuable. It gets back to my argument that if you can't compare a product from one company to another company, then I wouldn't buy the product. It's just too complicated a product. All right, so here we're going to get to a debate. Hart Williams. Let's look this guy up. Pretty famous guy here. I don't know if it's going to let me do it or not. Is A. Williams still in business? Look right there, one of the top ones that came up, how A. Williams changed the life insurance industry. Does anyone know his famous slogan? I wonder if State Farm, you hear it on State Farm. I don't know who else, life insurance. Anybody know his famous saying? It's not in there. Hart Williams didn't know anything about life insurance or investments. He was a high school football coach. My health teacher in high school was like a football coach. Didn't know anything about health either. He knew football and that was it. So his famous saying was, buy term and invest the difference. Any of y'all ever heard that phrase before? Buy term and invest the difference. When did he come out? Early 80s. What was he telling people to do? Don't buy whole life. Don't buy universal life. Buy term insurance. 10-year term was their main thing. Buy 10-year term and invest the difference. Now, what in the world does that mean? Which premium's lower, whole life or term? Term's always going to be cheaper, right? 10-year term's going to be cheaper because you only have 10 years of coverage. So you have a lot of extra money. Instead of paying $500 in premiums, you pay $50 in premiums. So you have $450 put that $450 into a stock mutual fund. At the end of 10 years, you'll have all this money in your mutual fund. You won't need the life insurance anymore. You're set for life. That was his argument. Buy term, invest the difference. And he was really good at it. Not only was he really good at it, but he was really good at hiring other salespeople just like him, like my high school government teacher. I had a weird government teacher. We were in a small room, about 1/3 this size, and he wore a microphone with speakers, like he was a college professor. I was like, okay, that's a little overkill. We can hear you fine. But he was selling us A.L. Williams insurance in that class. And he was a big believer. Y'all probably have heard of these multi-level marketing companies. Have y'all seen some of their big conferences, and everybody's just like screaming? And that's the way A.L. Williams salespeople are. Incredibly enthusiastic. They absolutely bought into the buy the term, invest the difference. He had an incredible sales force. It's really interesting. Anybody know the name of his company? See if it comes up. There it is. Primerica. Have you ever heard of Primerica? So Primerica got bought out by Travelers, and I think Travelers has spun them off back, got rid of them, and like bought them and say, okay, enough of that, sold them back off. But A.L. Williams, he founded it in 1977, just what we're talking about. This is part of this intermediation. A.L. Williams says, hey, forget about the universal life and the whole life, all that stuff, forget that. Just stop selling that stuff. Only sell term. You have all this extra money, you can invest it. All right, so that was the argument. I actually like his argument. Susie Orman, that I showed you last time, would like his argument. But he created, well, ultimately he created Primerica. I don't know where Primerica is today. I think it got spun off. We can see. I don't think it's multi-level marketing at all, but it certainly has the enthusiasm. These people, they believed in A.L. Williams, they believed in what they were selling, and they were good salesmen. And this is the company that was trying to sell my brother, so I've kind of given it away, telling him to switch from State Farm to their company, even though their company's product was more expensive than the exact same product he had from State Farm. But so let's see if Travelers is in here. Anybody see Travelers in here? There it is. 1988 Travelers. Well, there's something earlier than that. Travelers, let's see. 1993, Primerica fully acquired Travelers Insurance Corporation, an adopter named Travelers. Travelers Group included Primerica Financial, Smith Barney, and other financials. In 1997, Primerica announced it was going to begin offering prepaid legal. 98, Travelers Group and Citicorp merged. Citigroup attempted to sell Primerica in 2008. Yeah, 2008 is probably not a good year to try to spin off a company, middle of a financial crisis. So it has a long history. A.L. Williams himself got into some trouble, and I'm not really sure exactly what he got in trouble for. And I don't know if you can, this is when you really can't trust Wikipedia, right? Who knows, probably his granddaughter is going there and changing all this. I don't know if it talks anything about him going to prison in here. No. Legal issues, no. So it looks like his granddaughter got in here and fixed it all. But he did go to jail for a while. I can't remember what his particular issue was, and I don't think he was in there that long. So, I'm sorry? Counterfeiting, really? Like money? Wow, that's interesting. Okay, so, but an impressive guy. I mean, he radically, by himself, radically disrupted a huge multi-trillion-dollar industry, or multi-billion at least, and had a huge impact. The insurance industry just hated this guy for what he was doing. Now, the downside for him, when he had great salespeople, the downside was his products were not all that competitive. His insurance tended to be more expensive than his competitors. But remember, insurance is sold by salespeople, right, that are highly incentivized. So they sold the argument of buy term and invest the difference, and then they also sold the argument of buy your term from Primerica, rather than going out and shopping around. What people should have done is says, hey, I like that argument. Let me go see if I can get a better rate elsewhere. But when you have people sitting there and having, tea and cookies with you, you're like, you feel guilty, right? You don't say, well, that's a good argument. I'm going to see if I can get a better. Most people don't want to do that, get a better deal somewhere else. So they did a good job of selling it, but they did not have good premiums. Not only that, they started doing mutual funds, and their mutual funds had heavy loads, heavy fees. They're really horrible mutual funds as well. So you had that combination of a just good argument, buy term, invest in difference. Just don't buy the term from Primerica and don't buy the difference from Primerica. Go somewhere else and shop around. But it does show you the downside of this industry is it tends to be a sales push type of industry. All right, so what does that mean for us? So I want to get into this argument. It's the strangest. This is the hardest question on exam 1. So try your best. Again, I don't just give you the answer. You're gonna have to kind of organize it. So what I did is rather than giving you the answer, I took the debate and I had 2 sources. One was Primerica's website, which was arguing buy term and invest the difference. The other was the textbook I used for this class at one point, and I stopped using it after the first semester because it was so slanted toward the insurance industry. It was like if the insurance industry wrote a textbook, this is what they had, and it was very anti-term, and you should buy perm. So I took Primerica's arguments and listed them, and I took this textbook's arguments and listed them, and it's all kind of convoluted, so you have to organize it, okay? Don't you wish I would just write the answer for you and you just copy and paste it on an exam? That'd be nice and fun, but that's not what I did. So Williams comes in, he says, buy term, invest the difference. He revolutionized this argument. In this industry, probably sold more term than perm anyway, but it pushed perm because that's where they made the most money. They preferred to sell. When I was at USAA, I think USA was like 80% term and maybe even 90% term, but 80, 90% term and 10, 20% perm. And they had this push. We got to sell more perm. We got to sell more perm. And it was just hard to do. It's a hard product to push and get the sales force, especially because USA didn't pay commissions. It's hard to get your sales force to push a product when they don't, get a commission for doing it. So it's tough. It's much easier to sell. I don't know. State Farm would agree with this, but at USA, it's much easier to sell term, sell perm, but you make more money with the perm. So here's Art Williams' arguments. And then here's the textbook argument. The problem is they kind of offset each other. So it's going to get really redundant the way I'm going to do this, but I'm going to walk through Art Williams' arguments first. But while I'm doing it, I'm going to actually give you another side of the argument. You're going to find I'm much more on Art Williams' side, although I don't like his companies that much. I'm on his side. I just wish you would, get a better rate. If you can buy a better product, go somewhere else. So here's the arguments for buying term and investing the difference. And the first argument he made on his website, and I should look and see if that's still true. Is there anyone on Zoom besides me? Am I it? I think I'm it, right? Hopefully we're getting all this. Oh, that's right. I pushed them out of the way. Okay. So Avi, are you seeing Google here? And Taylor and Joe?
Yeah, we can see Google.
All right. Okay. I'm doing good, man. It's amazing. Let's see if they even exist. Oh, it'd probably help if I Primerica. So when I did the Primerica website, buy term, invest the difference was the first thing you saw. Let's see if we find that anywhere on their site. Oh, they got term there. Did you see it? Oh, there it is, buy term. So they still got it there. So I just went to their website and I got all those arguments and I just summarized them here. So they're still doing that, right? That's still their approach. All right, so let's look at the notes here. So the first argument they made, I like this argument. It's complete separation between the savings and the insurance. If you need insurance, buy insurance. If you need to invest or save, invest or save. There's no reason to bundle that into one product. That makes some sense to me. Just because a company has great life insurance doesn't mean he has great investments. So let's separate these two. Let's get the best of both. Now you notice Citigroup bought out Primerica. What Citigroup was trying to do was to create a one-stop shop for all finances, banking, insurance, investing. And their argument was, well, you can come one place, have everything, so you can see all that in one schedule. And most people said, you know what, I don't really need one place that has my insurance and my investing and my savings. I don't mind looking them up on different websites. That takes me like 3 seconds, and I don't look up my insurance every day anyway. There's really only been one company that's really had that argument work, and that's USA is really the one that's really worked that with banking, insurance, savings, investing, insurance, life, and State Farm, maybe a little bit, maybe Allstate, a few of them, but the one-stop shopping, including the banking, and I don't know, does State Farm ever get their bank up and running? I think you said they shut it down. Sold it off. Yeah, USA may be doing that next. Who knows? But it's hard to get all of those pieces to work together. And I don't think Allstate has a bank. I think USAA, it works because of the trust factor that they had for most of their history, that people just trusted USAA. But with Citibank, it didn't make a lot of sense. And I think Citibank found out real quickly that argument of having it all in one place. Most people said, you know, with the internet, I don't need that. I can find another way to bring all that information together. But that was, they're arguing the exact opposite. Let's separate all of that. Get the best of each one of those from different places. This argument, I'm going to say, has gone away, mainly because what did the insurance industry do? They introduced universal life. So they started the separation themselves, right? Remember universal life? They started separating those two. If you didn't want to pay for the savings side, don't pay for it. You can go invest that somewhere else. So they essentially, with universal life, have already done that. The second one is absolutely true. Term insurance is cheaper, no question, because you're buying it when you're young. You only have it for 10 years. You don't have to pay a premium for your entire rest of your life. So it is much cheaper, which means you will have more dollars to invest. Now, the problem with this argument is while Primerica was winning the argument, buy term, invest in difference, what were people doing? They were buying term and spending the difference. What happens when you buy term and you spend the difference 10 years later? Now you don't have any insurance and you don't have any savings. You don't have either one. And I've seen statistics that maybe 80–85% of the people were buying term and spending the difference. So that's pretty serious problem, right? So Primerica might be part of the problem in the United States where people are not ready for retirement because so many people bought into this argument. More control over your investment program. Now, some people argue, well, Americans aren't trained to be investors. That was probably true back in the 70s. What's happened since then? The mutual fund industry, 401k plan. We have access to very cheap sources of high quality management. You can hire Vanguard to manage your money for what, 0.06%, for almost nothing. So that argument really has gone away. And that's part of the argument I had in that textbook was you can't have people buy term and invest the difference because people don't know how to invest their money. Well, you don't need to. You can go to Vanguard and buy their 2050 target fund and you're done. And you're paying very low fees. You have very high professional management. But this is true. If you buy term and invest in difference, you can have more control over the difference. But what's the problem with the argument from their website? Are they asking you to separate those two decisions? What do they want you to do? Buy term from Primerica and invest with Primerica. So there's no longer any separation. I'm scared to click on their products to see what they have. They're probably much better products now because of Citibank and Travelers. They probably cleaned up their products somewhat, but they were not that great of products when they first started doing this. The other thing says, front load the insurance to the years when you need it, when you have dependents, when you're young, you get married, you have kids, your kids are going to be in college. So, buy a 20-year level term policy that covers all the time. Then your kids go to college, they graduate, they're off on their own. You don't need that life insurance anymore. Plus, you saved all that money for 20 years, so you got plenty of money anyway. Yeah, that makes some sense. The next argument is, y'all know the argument I think is the strongest argument of all. It's simple. I really think there's two things here. It's simpler, and because it's simpler, you can comparison shop between two companies. I think that's absolutely the strongest argument. We saw with whole life, all that stuff we had to go through to be able to compare two whole lives, and even then, we're based on history versus the future. Term life, if you got a 10-year term policy, you're going to pay a premium for 10 years. If you die, you get the face. I mean, that's all there is to it. It's very, very simple. The next argument they make is that, hey, if you need some money, you sell some of your mutual funds and you got some money. You don't have to mess up your life insurance by borrowing against it. I don't like this argument. I think it's a really weak argument. First of all, when you sell your mutual funds, you're going to pay taxes on the gains. If you borrow from your life insurance, there's no taxes as long as you pay it back. So I actually think the life insurance, whole life, has a stronger argument here because of the tax side. You can borrow from the life insurance, usually at pretty competitive rates. You can then spend whatever you need and you can pay that back. If you don't pay it back, so if you borrow $30,000, you don't pay it back and you die, the insurance company just pays you the face minus that $30,000. That's not any different than taking out of the mutual fund, is it? If you take out of the mutual fund and you die, what are your inheritance, your beneficiaries going to get? They're going to get that mutual fund minus the $30,000 you sold. You come out in the same place. I don't think there's a big difference there. I think from a tax standpoint, life insurance does have the advantage. It's a fairly efficient thing to do. You can borrow against the policy and you don't really mess up the tax side. If you're in a Roth IRA, you've got to, these are not the most liquid vehicles. Life insurance is not too bad. Now, there are tax consequences. If you borrow the life insurance, you don't pay it back in a certain time, it does become taxable. So you have to watch out for that. So I don't think that's a strong argument at all. On whole life insurance companies pay very, very low rates on the buildup. That was very true when they first started Primerica. Whole life is more competitive now. And in universal life, they're giving you much more competitive rates, right? Because they can reduce the rate. And so that gives them the ability to be much more competitive. But if rates fall, they're going to come down on those rates. I'm gonna make this argument when I get to the whole life side. What the permanent people say is, yeah, we don't pay the greatest rates in the world, but that's because these are really safe investments, right? But there's an argument against that as well. So essentially, when you're buying universal life or buying whole life, essentially your entire savings element is going into bonds. Now, if you're a 22-year-old, do you want all of this money going into bonds? You probably want it going into stocks, right? So it's not a good investment mix for a younger person. If you insure your entire life, you're buying protection for after you retire. Well, after you retire, you'll need life insurance from their argument, because you're buying life insurance to cover, your lost pay. And if you're not getting paid anymore, why would you have life insurance? Now, the other side is going to argue an argument against that. So you're buying, when you buy whole life, you're buying insurance to cover something you don't even have anymore, which is income after you retire. So that's a waste of money. So those are the arguments that they had on their website. I kind of confused it by putting these editorial comments in there, but I just wanted to show you there's arguments on the other side. Let's look at the permanent side, and it's going to get a little bit messier even here. So they argue, yeah, we pay low rates because these are low risk investments. Well, does that really make sense for a young person to be putting their money in the bond market? So modern portfolio theory, this is your paper one, right? Why do young people buy more in stocks and bonds? Because they have all this human capital. So why are you putting the life insurance into a bond? Doesn't make any sense for your savings element to go into a bond. So that argument is a pretty weak argument. One thing I should add here, I don't have in here, is this low risk. So I'll add this to your notes, guys. I really should have addressed this more. It's true what the life insurance company is buying is low risk bonds, but what is your exposure? So if that bond goes insolvent, what's the life insurance company going to do? So life insurance company takes your money and they put it into corporate bonds. And let's say they put it into corporate bond paying 5% and that corporate bond goes insolvent and you don't get, and the insurance company doesn't get the 5%. What happens to you? You don't have to worry about that, right? That's the life insurance company's problem. What are you worried about? You're not worried about their investment going insolvent. You're worried about what? The life insurance company going insolvent. Right? So that this article, this book was focused on the wrong risk. If that investment the life insurance company makes blows up, they take that hit, you don't. You take the hit if the life insurance goes under. Right? Now there is protection, there is like FDIC type of protection for you if that happens, but still your exposure is not to the investments they're making, your exposure is to the life insurance company itself. What if you live too long? So essentially what they're saying is, for some people, they live too long, they actually need that savings element. They're not disciplined to invest the difference. This is going to give them something to draw on later in their life. And that's that argument that people don't invest the difference. Again, they make the argument most people can't do their own investing, so come to a life insurance company and give it all to them. But that argument, I think, has completely been destroyed. You got Vanguard, Fidelity. You can hire very professional people to manage your money without much knowledge at all of investing. Liquidity, I do think, again, as we said, I think borrowing from a life insurance policy might actually be more efficient and much easier to do than actually selling the mutual funds. The next argument, I think, is their strongest argument on the permanent side. It's a forced savings. For whole life, if you buy whole life, you have to pay the premium. Remember, it's not universal. It's not unbundled. You have to pay the premium. And if you pay that premium, you will get a cash value that you can use if you need to later in life. And that argument, that's a strong argument. Now, I even worked with my mom on the universal life. Yeah, she had the unbundled products. She didn't have to pay the whole premium, but that's the way they were. They got a statement that says you owe $250. They paid $250. So it was a form of forced savings, even though they had the option. But now forced savings is getting easier in the mutual fund world because of, you can set up an automatic deduction plan and all that kind of stuff. 401k plans are getting much better, right? You can automatically put money in there and your company matches. Unfortunately for the insurance industry is they've started this unbundled product, so they've essentially are killing the forced savings argument by going universal life and variable universal life. They're essentially killing their own argument. But we know people don't save well, and even with universal life, most people with universal life will pay the entire premium every month because most life insurance companies do direct pay. Most life insurance don't like you writing checks. They want you to do it as an automatic bank draft, and they're going to set it up to take out that full premium. So I do think that's their strongest argument. It worked with my parents, even though the policy was horrible. If they'd had whole life, it would have worked really, really well for them because they bought universal life. It blew up on them, but it was a forced savings. So I see that as an argument. And this one, I think this one works. I can't find a lighter yellow, lighter green. So if I could put light green, you do need life insurance later in life to pay estate taxes and those type of things. It's kind of nice to have something that's tax-free that comes in all in one big chunk, and your beneficiaries, they have that money and say, okay, we're going to pay the estate tax with that. I can see that argument. And I've seen a lot of life insurance salespeople, they do it that way. They say, okay, we're going to use 10-year level term to cover most of your needs, but let's buy some whole life policy, so that you get to end of life, you have something there to pay those estate taxes, something that is there. It's going to pay your burial expenses, your funeral costs, pay your estate taxes. So let's buy $400,000 of term life, and let's buy $100,000 of whole life, and you'll just have that whole life there. It's not a very big premium because it's not that much, but you'll have it there. It's there. It's always there. Yeah, I can see that argument. That makes some sense. All right, so see how convoluted that was? So you have to somehow organize that into a good answer. And so you have to decide, are you going to do one argument first and then the other one? Are you going to argue them kind of point by point and give one side versus the other? So this is an organization answer. And the reason I did it like that is that's part of the critical thinking. You've got all the points. You just got to now organize it into an answer. Okay. So ask questions on this. Which of these points did you find most convoluted or hard to understand? Or maybe I should try this. Your uncle, I'm going to pick on your uncle this Thanksgiving. Your uncle says, hey, I need to buy some life insurance. You say, well, are you going to buy term? Are you going to buy whole life? And he says, oh, well, I don't know. What should I do? What do you say next? Where are you on this argument? Are you going to go work for Primerica, or are you going to go work for MetLife? If I swayed you one way or the other? He's 22. He doesn't have any debt. He's a college student. He's married. He has 7 kids, but he doesn't have any debt. No, he's 22 years old, so his kids aren't. He's, his term. Yeah, if he's 7 kids, what would the term argument be? He can't. What's not going to work with whole life? Not going to be able to afford it, right? He doesn't have money for life insurance. So term is about all he can afford. All right. What if he's 50 years old, no debt, he's got a few $100,000 saved away, he's got kids still in college. Whole life term. Well, they're still in college. Who knows? If he was in Europe, they're going to be living at home. If he's in Italy, they're going to be living at home, another 15 years. You've seen some of those stories, right? There's some cultures where kids stay home a lot longer than others. All right, so then it's a little trickier, right? What the answer is going to be, what would make more sense? Because what do we know about the term now? He's in his 40s. It's going to be a little more expensive, right? He's getting up there in age. So there's probably going to be a closing gap between the term. When you're really, really young, you're so unlikely to die in the next 10 years. That term is really going to be cheap. As you get up into your 40s, and we'll see that when we're pricing the policy, you're going to see the gap starts closing as you age, because it's just youth is such a huge advantage for life insurance. So it's not an obvious answer. You probably want some numbers. If the term is $10 and the whole life is $800, then yeah, that's kind of easy. But if the term is 100 and the whole life is 250, you have to see. Would you go with the, why don't we do $300,000 a term and let's do 100,000 of whole life? Would that make sense? You think he's always going to have some need for that? I mean, the advantage of whole life is what? You get it tax-free. It's there. It's always going to be there. So when the term runs out in 20 years or whatever, he's got that 100,000. It's always going to be there. It's not that expensive because it's only 100,000. Maybe that's an argument. I could see that argument. So.
If he has so many
Right, but the whole life's gonna cost them quite a bit more.
Right.
So, yeah, I mean, it's, I mean, I'm kind of being facetious with 7 kids.
As far as that like forced investment though, like not forced to invest. But if he does, he makes a decision.
Yeah, so what is he gonna invest in, and how much money does he have to invest with that kind of expenditure? Part of my point with 7 kids is, you know, if you can't afford insurance, you can't afford insurance. You know, there's other choices, and that's kind of my argument with the lawyer on the Part B and C of the auto insurance. It's like, yeah, I mean, you could buy that, but boy, I think you'd be much better off buying term insurance than buying Part B and C of auto insurance. If you're that kind of person, like, you know, 7 kids, your death is probably the most, you're much more likely to die prematurely than you are to get hit by uninsured motorists and be seriously injured. That's a far lower probability. So the term, and if you get killed by uninsured motorists, what's going to happen? The term's still going to pay. So you're just worried about getting hit by an uninsured motorist and being seriously injured. You know, so essentially what you can do is you got to lay it all out there with the premiums. That's what most people don't do. You got to put the premiums down there, and you got to, you know, what I'm going to do. Okay, so if I only have to pay this in premium, what am I going to do with the difference? That's all the things you got to put together. But that's what you're trying to do here is, how would you talk to someone about this decision? Maybe the most important thing you got to tell them is, well, whatever you do, make sure you go to at least 5 life insurance companies. Don't buy from the first person that comes to sell it to you, because life insurance premiums are all over the board. It's, I think it's, to me, kind of comical that people are real picky about auto insurance, and auto insurance rates tend to be really pretty similar. Different companies are pretty similar. There's not radical difference. And you get the life insurance side, they're all over the board. I mean, it's pretty shocking how different the rates are, but people are real picky on shopping auto rates, but they're like, whoever sells them the life insurance, that's what they go with. So definitely shop rates, because that can have a big impact on what you're doing. All right, so any questions on that? So you see what you're doing. So that's what critical thinking is sit down with someone and actually walk them through the decision. That's when you know you're understanding what we're doing here, all right? So I'm hoping your uncle shows up for Thanksgiving. It's kind of late for the first exam, so maybe, are y'all going to see your uncle this weekend, anybody? So y'all need to set up a Zoom with your uncle and go through all of his financials. So the insurance industry's made it much worse, that argument, because of all this variable life, or universal life. They're trying to do it all together, but separate. I'm not sure that's all that different what Primerica is doing with trying to sell their own mutual funds, but everybody's trying to get their own piece. All right, so I had a friend ask me this question. He's in the military, getting married. I was the best man at his wedding. So this is part of the best man's responsibilities, is you buy perm or term, right? If you're going to be a best man in someone's wedding, you got to help them with the perm versus term argument. And so I go, okay, I actually built this for him. So say his name's Ken. He loves it. I talk about this in my classes. He's retired. He retired from the military. It's funny. The first time I saw him after he retired, he had always had a military haircut. First time I saw him retired, his hair was all the way down to his shoulders. I was like, I didn't even recognize him. So anyway, wild and crazy guy here. But gets married, so he needs life insurance. Do I buy term or do I buy perm? And so I said, okay, well, term is you buy term, you invest the difference. Perm, that's all in the same product. So I said, I'm just going to build those for you. So I built them these 4 scenarios. And on this exam question, you have to draw 2 of these graphs. Not precisely, but you have to draw them. I use real life numbers to do these, all right? I took out a mortality table and I used real life numbers, okay? So this is not fictitious. For him, I actually used the premiums he got from the insurance company, and I built these with his actual numbers. I did these off of UTSA site. I did their whole life and their perm, and I just built them with actual numbers. So you're buying a $250,000 policy. You're going to buy the term, and let's say you're going to invest the difference. And when you invest the difference, you're going to make 3%. Okay, so that's the scenario. What you've got to do is draw the lines, and you need to make sure you identify what the axes are. So the excess is the proceeds that you get at death. That's what the excess is. That's the y-axis. The x-axis is what actuaries call attained age. What is attained age? Attained age is your age. Okay. Now the actuaries will give you 6 more paragraphs, but for finance people, attained age is age. Okay, that's good enough for me. One of you actuaries want to come back in a few years and tell me why attained age is more insightful than just age, I'll take it. One of y'all look it up and let me know. I used to know that, and I was like, you got to be kidding me. Your actuary is a little too precise, but I've kind of forgotten how to describe that anymore. So this is the attained age. This is the age of the person. All right, so let's understand this. The blue line is whole life. Whole life is real easy. If they die with a $250,000 policy, what do they get? 250,000 bucks. You can't get any easier than that, right? Whole life is straight line. Term, it is a 30-year term. So in 30 years, what happens at 30 years? They lose the insurance. But what do they have? They invested in difference at 3%. Now, why does the term have the line way up here? What happens if he dies at 54? He gets the $250,000 life insurance, and what else? His investment, that 3%. So if he dies, like if he's really sick right here, you might say, you know what? I'm expected to live 1 more month, but if I die today, you'll get an extra 250,000 bucks. Life insurance creates some really bizarre family discussions, but hopefully he's real healthy right here. He knows it's going to drop off down to 100,000. So if he dies here, he would have been better off with the whole life because he would have gotten, his estate would have gotten 250. But there is a point, well, if he bought term and invested the difference, he would have actually been better off. So if he dies at 99, he's much better off having bought the term. Now, what does this orange line here represent? What is that? That's 100% what? How much life insurance is there? 0, right? No life insurance. That's entirely his investment. Now he's investing more money here. Why is he investing more money here? Yeah, he's investing the difference and the premium. So he's investing everything. So he's got more money to invest. All right. Now, what can we do to change this line? Well, what if he can make 4%? What happens then? It drops, but not nearly as much. What if he can make 6%? Well, in that case, there's almost no difference. He might as well just buy term and invest the difference. He makes 6%. How do you think I got this 8.58%? You can tell how I got that? His worst case was he'd make $250,000. Now, whom do you know that's making 8.58% after tax? So maybe he's putting this into a Roth IRA or something. So who's making 858? Probably nobody, right? So there probably isn't a scenario where the buying a term investing difference always wins. But what does A.L. Williams say? Well, you're going to retire at 55 anyways, so you don't need the life insurance. That's his argument, right? So you don't really care. If you die there, who cares? You don't have any future earnings, so you got enough to pay your funeral. You're okay. So, all right, we'll go through this again. I'll just let it sink in. Y'all see the distinction there between those different policies. And that's what I gave him. What did he decide to do? He bought term and invested the difference. And he was actually pretty good at investing the difference.
Does this represent like a single investment? It's always 3%?
Yeah, I just said 3% every year. So maybe you made 4%, 2%, 3.2, you know, but you average out 3% over that time. I just did a fixed rate to keep it simple. But yeah, 3%. You could probably make 3% in this market on average pretty easily. I mean, there's tax-free municipal bond funds that are paying 2.5%, so you're not too far away already. So, all right, I'm going to let you out a little bit early. Any questions? Any comments? Paper one's going well. Anybody finished it yet? Sound like it, so you're getting close. All right, so we'll stop there. Thanks to everybody that's on Zoom there. See y'all next week.